Correct. We do not have class next week. The exam will be online.
Okay.
And in fact, I've got some good news. I'm going to put the exam online today.
I love you more.
And you can take it anytime between now and Thursday at midnight.
Okay, the last day is going to be Thursday?
Yes.
Okay.
Whatever week. Next Thursday at midnight, just get it
Yes.
done before that. All right, so let's go through class one step at a time. Question?
How many questions on the test?
22.
Ah, that's fine.
21, 22. 3-hour time limit. I imagine everyone will get done before then.
Mm-hmm.
So there's a couple little tricky questions. But
I know. You always do that.
on the whole, I would say it's a fairly easy exam.
Okay.
All right, so class one. What do we got here? Time value of money, future value. Everyone knows this formula? Future value, present value with some junk. All right, if I ask you a future value question, just flip to that page, crunch it on your calculator. Present value is just a future value formula rearranged, right? And if you, Patrick, if you need me to slow down, let me know. Okay. Perpetuity, value of the perpetuity, payment divided by the interest rate. If you asked a perpetuity question, flip to that page. Now, what's the difference between a perpetuity and a growing perpetuity? Anyone remember? Or a growing perpetuity is if you get payments forever, but they're growing by some amount. They grow 2% per year. And if we ask you on the exam, what is the value of this perpetuity? You're going to get $100 next year, and it's going to grow at 2% every year. You're going to use this formula. Payment divided by the interest rate minus the growth. And it's going to be a little bit bigger because the denominator is bigger. All right. Chapter 2, free cash flow. All right, free cash flow is ultimately the value of the firm, how much free cash flow it can generate. And we have a way of calculating that free cash flow that we like, which is NOPAT. We like that NOPAT figure, net operating profit after taxes, because it assumes no debt. It is devoid of interest payments. And in addition to calculating NOPAT, which we do by taking earnings before interest and taxes and taking out the taxes, we need to subtract operating capital. Now, operating capital can incur for a couple of reasons. We can increase operating capital if, say, we buy a building. It doesn't show up on NOPAT, but it decreases our cash flow. Operating capital, hey, how you doing? Hey, how you doing? All right, the cavalry has arrived. I've got a little take the pressure off the three of you. So operating capital can also decrease if we do the stuff we talked about last week, which is, say, increase inventory, or say we increase accounts receivable, or say we pay off our accounts payable too fast. Did you watch the video from last week, CMR?
Mm-hmm. Yeah.
All right. So those are the reasons why operating capital can decrease. That's all stuff that will not show up on NOPAT, but will decrease the amount of free cash flow that you have. And I think there is one calculate the free cash flow question on the exam. Okay, and then working capital. We talked about this working capital. So in addition to the fact that you buy a building, and that's going to decrease free cash flow, you could also increase working capital, the ways we talked about last week. Higher inventories, higher accounts receivable, lower accounts payable. And you might want to just earmark this page if you need it to calculate working capital. It does include cash, inventory, receivables, does not include short-term investments because they're not part of operations. Okay, we did an example of that. Calculating NOPAT, calculating free cash flow. Okay, and then we talked about capital budgeting. We talked about net present value, which is pretty much the same as value, except it's with the initial investment subtracted off. So if you're given a problem, say it has these cash flows over the next 5 years, it's going to cost $100 to start, and the appropriate risk interest rate is 8.5%. you can use that information to calculate the net present value of that project. And in Excel, I believe, correct me Patrick if I'm wrong, but I think in Excel to calculate the net present value, you hit equals, open parentheses, discount rate, comma, cash flows starting in year 1, comma, initial investment, close parentheses. Does that sound right?
How long do we have for this? Because in case we have to Google that or YouTube it, we can. I will.
You'll have 3 hours, and I mentioned earlier that it's only 21 or 22 questions.
Okay.
It's
Not
a
only-
little tricky if you're not familiar with it.
Yeah.
Wait, what was that?
You and Pat tried it. It's a little tricky.
Wait, did you try it, Patrick, after I sent you that email?
I tried it, and I was trying to remember what we were doing that night. And I was looking at your email, and I just.
I tried
Yeah.
looking at it with him, and we couldn't get the number.
Okay, we can do it. Should we do it now?
That's no.
Do it now? Is that yes? No?
Yeah.
Sure.
All right. Yes. Do it now. All right. Let's see. We're all programmed. Microsoft Office.
I have your number.
Oh, you got
Yeah, I gave it to you last night.
Actually, let me
Net present value Excel.
materials. Okay. Okay. All right. So let's see. So here is some stuff. All right. I've got this this cash flows. All right. The initial investment is 844. Can everyone see that? Okay, initial investment 844. In year 1, we're going to get 298. Year 3, we're going to get to year 2, we're going to get 334. This is year 3. This is year 4. And I've calculated the NPV is 25. So let's see if I can calculate it in this. So I'm going to hit equals, open parentheses, NPV, equals NPV, open parentheses. So first I need the rate, which is 6%, comma, and then I need the cash flows year 1 through 4, comma, and then I need the initial investment, close parentheses, fingers crossed, 25.23. Ah, man. All right.
He's like,
Okay.
Do you want to watch the 8-minute YouTube video that I'm watching right now?
No, even it's too.
Wow, how did that happen? Alright, NPV, rate, value. Alright, let me pull up the email I sent Patrick. See if that will help.
No, we didn't combine them. Let's combine
Email
eight, and we just put each one in the parentheses and number. Maybe that
I know.
Maybe in Excel.
That's
Okay, rate, cash flows year 1 and beyond, minus, maybe we need to go close parentheses minus the initial investment.
See if that does it.
Alright, so let's try that. Okay, equals NPV. Okay, and then we're gonna go plus because it's a negative initial investment. Alright, why don't we try minus? Minus, that's not gonna work because it's gonna be okay. Equals NPV, the rate. What if we $sign this?
I was just curious.
We worked that out last night. With including the initial investment after the first comma, but we need to close parentheses and add the initial investment. Alright, here's the YouTube video. Alright. Sorry, equals NPV. Open parentheses.
You don't have to make the values constant like you do with a VLOOKUP. Do you know what I mean? You know when you do a VLOOKUP and you're doing a whole big spread, and if you're like bringing down the numbers,
Mm-hmm.
and you put the $sign in there, so it stays constant, so it's not look. I'm just wondering if it's the same thing.
Yeah, I see what you mean.
Because if you're kind of opening up and you're starting with year one and you're kind of bringing it all over, is it just bringing over the 270? Even though it's in the formula,
Yeah.
it's bringing it over. Like when I run mine for work, like I have 230 stores, and if I pull up that first one, I have to make a constant of that number. The top one is going to come all the way down.
Yeah.
So I'm just wondering, instead you're not going down, you're going across. Do you have to make that constant? Did you look at the YouTube video?
No, I didn't look at the YouTube
Because
video.
there's one on here, like at 122,000 views.
Did they do the
It says
dollar
how to
sign?
calculate a net present value NPV in Excel.
Did they use the dollar sign?
I'm gonna look right now. Hold on.
What if we do rate and dollar sign?
Yeah, try the dollar
Rate
sign.
dollar sign.
Let's see if that does anything.
Plus. I don't know. Alright, so we'll try it again.
I think
At
he's
the end of
saying
class?
just do one cell basically instead of the whole row. Maybe
Yeah.
that would work.
That's what me and Kat did.
Like, don't do
But-
2, 3, 4, just do one.
Equals PD. And first we do the rate, right? Then we do the comma. And then we do like this.
No, she's saying just
do
one
the
or
first
comma,
one.
like first year,
Got
and
it.
then comma second year.
Got it. Comma. Alright. And then close parentheses.
Okay.
And then plus.
Wait, here it is. Okay.
Oh, I know what I'm doing now. Oh my God.
It's
I got it,
NPV,
I got it,
discount rate,
I got it.
range of
This-
values plus investment.
These are the cash flows. We need to use these cash flows. This is present value already. Okay. This row 5 is the cash flows. Okay. Oh, equals NPV, open parentheses, rate, comma, and then we use row 5. These, okay, yes. Then we close parentheses, and then we go plus, and this will definitely work.
Okay.
Ah,
And so-
bingo!
Alright.
Go back to the formula again.
How did you select it like that? Did you press shift and then?
Yeah,
Oh, okay, that's what was confusing me.
Wait, shift where?
he was
Or you
asking
can
how
just
you
drag
selected,
it
drag all the cells. You could
I'll do
drag
it
it, you could
Equals.
shift
Oh,
and
what's it?
the arrow.
Picture
Oh,
of it.
sorry. No, I got you, sorry. Alright, so equals NPV, open parentheses. First you select the rate, comma, and then you select all the cash flows, not the row below, which is already in present value. And then you close parentheses, and then you plus the initial investment.
That's the one who's going to be on the test?
There is one like this on the test, and I would recommend you have it all queued up so you can just plug in the numbers.
Which is basically equals NPV, open parentheses B9, which was the 6%,
Comma.
comma C5 through F5, which is your cash flow for year
For all the years.
year 1 through year 4. Close the parentheses, and then you're adding
Initial investment.
the initial investment.
Yes. Okay. Excuse me. Alright. So we've got net present value. We know how to calculate that. Independent. What's the difference between independent projects and mutually exclusive projects? Mutually exclusive projects, the cash flows affect each other. So if you have two independent projects, you just look at them independently. And if they're both positive NPV, you take both projects. If they're mutually exclusive, meaning one affects the cash flows of the other, you take the one with the higher NPV. Okay, that's good. Class 1, right? Alright. Excellent.
And you added our, I saw that you added our participation grade in there?
Yes. Yes. And you missed the good news, Bill. The exam will be open tonight.
Are you serious?
Yes. And you can take it anytime between now and midnight on Thursday.
That is awesome.
Yes.
Alright. Good, I like when students say that. It's
I,
awesome.
my biggest fear was like Thursday morning, getting up at like 12 o'clock at night, and then like starting and falling asleep, and then because
Alright.
Thursday afternoon I'm not gonna be in the right frame of mind. So
Alright, so beta. What is beta? Beta is the measure of risk for a stock relative to the market. This formula you may need to conjure up, bookmark that. If you are asked what is the cost of equity capital and you are given the beta, you will use this formula to take the risk-free rate plus the market premium times beta. And it can be a little confusing because sometimes you'll be given the market premium and sometimes you'll be given the risk of the market as a whole, which already includes the risk-free rate. There's a couple tricky questions on the quizzes, but you need to be able to differentiate between those two. Remember the intuition of beta, measuring the risk and the required return. And we looked at this graph and we said, well, look at these two managers, CC versus JJ. We can see CC has a higher return, and CC's like, yeah, I did a better job. But we, being smart finance students, said, wait a minute. CC took much more risk. CC had a higher beta. Therefore, we demand a higher return from CC. And look at what a great job JJ did by decreasing risk and still picking stocks that outperformed. Cost of capital. We may need to calculate WACC. I believe there is at least one. Calculate the WACC, weighted average cost of capital, of this for this company. We will need to just put everything together. We will need to calculate the cost of long-term debt, cost of preferred stock, cost of common equity, and then we will weight them, given the formula that we've got in these slides for Class 2. In terms of calculating each one, let's take a look at loans. All right, now we will be given either the before-tax cost of debt or the after-tax cost of debt. The before-cost tax of debt is higher. Say the bankers charge us 10% on debt. That's fine, but we get a discount because interest payments are tax deductible. So we take the before-cost tax of debt, cost of debt, times 1 minus the tax rate, and we get a smaller figure for the after-tax cost of debt. That's how we calculate cost of debt when we're using WACC. Preferred stock, remember we talked about this being a layer of ownership between debt and equity, which had some interesting characteristics. One of which is that it generally pays a fixed dividend consistently. So we can use that fixed dividend to calculate the cost of equity. If Bill has a preferred stock share that he paid $100 for, and I pay him $6 each and every year, the cost of that capital, the cost of using his $100, is 6% each and every year. And that's the way we will calculate preferred equity. This $6, I mentioned I might be paying Bill, the price he paid, $100. And there's one other little kink to it, which is maybe when Bill purchased that stock for $100, he had to pay a broker a certain amount, and maybe I only got 95 of those dollars. So that changes the return. So it goes from a 6% return up to a 7 or 8% return.
because of that fee from the broker.
Yeah, so I'm getting less. I only got 95, but I still need to pay you $6 every year. So the cost of that capital is 7 or 8%. Okay. All right, and then calculating the cost of equity. There are two ways. One, we mentioned the capital asset pricing model, which was this formula we talked about a minute ago, the risk-free rate plus the market premium times the beta of the stock. There's another way we could sometimes calculate the cost of equity capital if we pay a consistent dividend to equity holders, we could calculate it that way. And the difference between equity holders or common stock holders is that they expect a growth return. They expect that stock to grow. And that's different from preferred stockholders who just expect a fixed dividend each and every year. So we use the same formula we talked about it a minute ago, except we add a growth component. The investors expect maybe a 2% growth each year. Not only that, but if we're given the dividend in our current year, the common equity holders will expect a higher dividend the next year. So we're standing here in year one. All right, the common equity holder, Greg, gives us $100 for this stock. He's expecting a dividend, currently there's a dividend of $5, but he's expecting a growth rate of 4%. So he's expecting $5 and change next year. So that's how much we'll have to pay him. We'll have to pay him $5.40 or $5.35 next year. So that amount that we need to pay him, divided by what we got, what he paid for that, with the amount we paid to a broker taken off, and then we add the growth to it. Mallory.
If there's dividend included in the question, then we would definitely use DCF.
It'll actually say, calculate the cost of equity using DCF.
Oh, okay.
If it says that, then use that. Otherwise, you'll probably use the capital asset pricing model.
So if it doesn't state anything, use capital.
Yeah, there's nothing ambiguous like that.
Okay.
It'll either give you obvious capital asset pricing information.
So it's going to give you one of the two. You're not going to kind of throw us a curveball.
I will not. Okay.
Because we'll get you.
Yeah.
We'll find you.
Good. Okay. Boom, boom, boom. Okay, there was this one thing in terms of estimating the growth rate. And we talked about a retained earnings retention model. Say, for example, I'm getting a return on equity of 12%. Question is my company going to grow at 12%? Well, if I'm not paying out anything to my investors, if I'm not paying any dividends, then maybe it will. That's the appropriate rate. It'll grow at 12%. But if I'm paying out, say, 3/4 of that in dividends, and I'm retaining the rest of that, then I might expect my company to go at 3/4 of 12%, which would be 9%. So if for some reason you get a question that says, what would be the growth rate of this company that had a retained earnings of 12% and pays out 3/4 of that in dividends, or 1/3 or 1/4 of that in dividends, or whatever the way we said that. You can use this growth rate, the retention rate times the return on equity, or 1 minus the payout rate times the return on equity. Make sense? Oh. Weights, you'll just look at the numbers, determine the weights for WACC, and calculate WACC. Slide number 40 on class number 2. You can pretty much do it in your head. You can have that circled and bookmarked so you don't get stressed on the exam. Good. All right. Class 2, any questions on that? And if I'm going too fast, just tell me to slow down.
How many classes have we had altogether?
8 classes. This is the 9th class? Yeah.
Stanley.
Class.
Fast, it comes going too fast. I'm so happy.
5. Got capital structure decision. Okay. Oh, so this is capital structure. How much debt and how much equity. And we talked a lot about how we can use debt to increase the value of our company. That can be risky, but if we do it right,
That's when we do that slope and kind of where
Yep.
on
the
there.
perfect point,
Correct.
reserve borrowing capacity. All right. We talked about business risk versus financial risk. Business risk is just the risk you think about running a business. Will your customers buy? Will your employees work? Yada, yada. Financial risk, we use that example where suppose you invest $1 of your own money and then borrow $9 from the bank. that increases the volatility of your returns, and a very small decrease in profit can wipe you out completely. That is financial risk. And if you get yourself in that situation, your investors will demand more of a return because you're more of a risky company. Okay, capital structure theory. Modigliani and Miller gave us the zero taxes and corporate taxes, which we'll talk about briefly, which leads to the trade-off theory that Bill just mentioned with that perfect arc where the value is. Signaling theory, what does it tell the market when you ask for more equity or you ask for more debt? Which leads us to the pecking order theory. We'll talk for a minute about agency costs, reserve borrowing capacity, and then we'll talk about market timing just as an afterthought. In terms of Modigliani and Miller, their theory, they said with zero taxes, the value of the levered firm is the same as the value of the unlevered firm. But they didn't think about a couple things. Well, they thought about them, but they just didn't include them in this pure theory. They didn't include taxes, and they didn't include financial distress costs, such as bankruptcy. So they created another theory that did think about taxes. And they said with taxes, the value of the levered firm, which means with debt, is equal to the value of the unlevered firm plus the tax benefit. So when you're paying interest, that's tax deductible, that saves you money, that lowers the cost of your capital, and when the discount rate, the cost of capital goes down, value goes up. So as you put more and more debt in your company, the value of the levered firm gets greater and greater. But we need to think about the cost of financial distress. That brings us to the trade-off theory, which says as we increase debt by more and more, the chances of financial distress get greater and greater. All right, so what happens? So we've got the value of the firm on this axis, the amount of debt here. All right, the value of the tax shield goes straight up, but the value of the levered firm starts going up and decreases a little bit. And the reason why is your investors say, hey, wait a minute, you're taking this whole cheap debt too far. A very small decrease in returns could wipe out your whole company, cause another recession. So we're going to charge more and more for that capital. We're going to charge you higher rates on your bank loans, and for equity investors, we're going to demand a higher return. So your cost of capital goes up, the cost of your firm starts to go down, and you want to find that sweet spot. In fact, you might want to be a little bit to the left of that sweet spot. Why?
Risk.
Risk. Just in case, you might want to maintain a reserve borrowing capacity, because if you're right on the edge, and all of a sudden you see a great opportunity, borrowing a bunch of money might decrease the value of your firm, freak the market out. And it might send the wrong signal. So what sort of signal does it send to the market? If you decide, you want to, how do I want to say this? So the signaling theory indicates what the market thinks about our intentions or our value if we decide to issue more equity or if we decide to take out loans. So if we decide as a firm to sell stock, what sort of signal does that send about our opinion of our stock price? Okay, all right. If we decide to sell equity, ask equity investors for more money, sell them stock, what signal does that send about our opinion of our current stock price?
It's too low.
Isn't it if you're raising the stock price? Is that what you're saying?
No, the stock price is the stock price. So
We
the,
sell it to
the
investor.
stock price is currently $105 per share.
Okay.
We say, hey, you know what? We've got this new project. We want to sell another 1 million shares.
Okay.
Will you buy them? Come buy them. All right, what are you going to say?
What is going on?
They're increasing their projects. Is that what you were saying?
Yes, they need $1 million. So the question is, where do they get that money? Do they take out a loan for $1 million? Or do they sell stock for $1 million? Or do they use internally generated funds of $1 million?
So should they need income?
Yes, it'll bring us to the pecking order theory, which says we use income right now. Income might be our first choice, but why is it? What signal does this send to the market when we say we would like to sell stock?
You're looking to expand, I guess, or you're joining.
You're still
I get your point. I know what you
I remember.
Yes.
Great. Explain, break that for us.
It's overvalued.
Okay, it might be overvalued. We definitely don't think it's undervalued. So when the stock price is high, we're going to say we want to issue more stock. If the stock price is low, we're going to want to take out loans. Or we're going to want to use internally generated funds. So when we issue more stock, investors are going to look at us and say, you're only issuing stock right now because you think your price is high. Alright, so that's the signal we need to be aware of. If we issue stock, investors might say, you're only issuing stock because you think the price is too high. That leads us to the pecking order theory, which suggests we should avoid issuing stock and sending the improper signals. We should first use internally generated funds, retained earnings. We should second, we should take out loans. Third, we should go to equity markets and buy more stock, or sell more stock, excuse me. Make sense? All right, we talked briefly about agency costs. This is the issue of we as the owners have agents who are the managers of a firm who may or may not be acting in our best interests. Agency costs. Our agent is costing us money because they're not doing something that's in our best interests. And in this particular point in the content, we talked about the idea of financial leverage forcing discipline on managers. So they have to make those consistent interest payments. They don't have time, they don't have room for extravagant projects which may decrease value. We talked about agency costs a little bit in later content, but just agency costs potentially cost the owners money because the agents are not operating in their best interests. Okay, reserve borrowing capacity, we talked about this. Keep a little extra so you don't have to ask for a bunch of money and freak the market out. Market timing theory, okay, just add confusion now that I've refreshed you on signaling theory, is the exact opposite, which means sometimes managers, if the price is high, they will sell stock and they will get a good PR person. Say the reason we're selling stock is because we have all these great opportunities, not because we think the stock is overvalued.
Just putting a different spin on it.
Yes. Okay, we went through a capital structure. Yeah, we went through a capital structure example. Let me go through it this way. I'm going to come back to this slide after I go through this example. All right, so we went to a capital structure example, and there are a couple questions about this on the exam. One actually asks you to calculate the change in capital structure, and the other is just an intuition question. So we'll spend a couple minutes on this right now.
Didn't we have a question like this on that exam for that class?
Yeah. Like I said,
Okay. I just remember all the numbers in it. It was
the exam's not going to be harder or different than the quizzes.
okay.
So, you are a company considering adding more debt. Suppose you're at 0%. You go to a banker, you go to a financial consultant, say, what if we increase our debt to 20%, 30%, 40%, 50%? You ask the banker, how much will you charge me on these loans? The banker says, well, at 20% I'll charge you 8, 30% I'll charge you 8.5, yada yada. Well, first question, why does this increase? as we take on more debt?
More risk.
More risk. Outstanding. All right, this weight of stock is just the mere opposite of the weight of debt. Beta, which is the risk of to our equity investors, which is different to the risk to our debt investors. This increases. Right? It goes from 1 to 1.5, 1.2, 1.4, 1.6.
The higher the risk, it's everybody that has to deal with that risk costs.
Outstanding. So risk increases. All right, and then beta, if you have these beta, how can you calculate the cost of stock, cost of equity? Get from 1 to 12% or 1.150 to 12.9%. How can you calculate this line once you have this line? How do you calculate the cost of equity given the beta? Multiply what? Starts with capital and ends with asset pricing model?
So you would do like you would do the 1150 times 80%?
No, it is the risk-free rate plus the market premium times beta.
Okay.
That whole thing. Make sense? Now, question though, we'll come back to this in a minute. All right, and then let's see what happens. So as we increase debt, our weighted average cost of capital starts to go down and then starts to go up. Why is that?
The risk?
Yeah, okay. Why does it go down, Patrick?
Taxes. Interest.
Tax benefit.
Tax benefit, yes. Debt is cheaper.
Because interest is tax deductible.
Yes. Then it starts to go back up. Why does it start to go back up, Patrick?
Because of the risk.
Yes, because of the risk. They're like, all right, now you've taken this too far. And then it starts to go up. We want to find that sweet spot, which gives us the highest value, highest price of stock. One last thing on this. There is a way you can calculate the beta if I tell you that the company is taking on more debt. It's called the levered beta. So if I tell you a company's unlevered beta with zero debt is 1.2, and then they're taking on more debt, here's the information, you can calculate the new beta. And you can do it with this Hamada's formula, slide 40, class 3, wherever we are. This is this formula. The unlevered beta times 1 plus 1 minus the tax rate times the weight of debt divided by the weight of stock. You will have to do that one time on the exam. Okay, sound good? Excellent. There's class 3, class 4. Okay. IPOs. Initial public offerings. This is a fun class. I enjoyed it. Alright. There are some advantages to going public. Liquidity. Right? Instead of having all your wealth tied up in this company, you now have stock, and you can sell that stock to people. Diversification. Alright, you can have cash instead of all your money in your company. Capital. Money for the company to grow and expand. You're not a private company anymore. You need to be public and expand to different markets. You can get a value for your firm, whereas before you had no idea how much your firm value was. You could potentially be a lucrative merger target. And you could open up new markets. The public awareness of going public, the publicity and whatnot that comes with that could help your business. There are some disadvantages to going public. You have to report to the SEC. You have to disclose things to your investors. Price risk. Right? You're going to establish a firm value, but it may not be a good firm value if your stock is not heavily traded. Owner control. You have other owners who may hassle you. And you have to keep them happy with investor relations. Investment banks. What do they do in this IPO process? Determine price, just like you all could determine price. You all know how to determine value. All right? It's not that much different than what they do. They sell the shares to their preferred clients. They cover the stock, which means they have a respected analyst analyzing your company. And the analyst says the stock is worth this much. And people say, okay, the respected analyst is covering the company. I will buy it for this much. And they will make the market. They will hold shares so that if someone wants to buy it, they can buy it. If someone wants to sell it, they can sell it. Value. Okay, investment banks. Sometimes they'll do a best effort. They'll sell all your shares the best effort they can. Most of the time, though, they'll underwrite it, which means, Bill, you have your company you're going to take public. They will buy all the shares for $40 million, and then they will sell those shares to the investors for a little bit more.
So they kind of just basically just advance you the money that you probably will get.
Yes. Well, no, they give you the money. They take all the risk. But as we saw, they're very strategic about taking the risk, and they make a lot of money when they do it. And there's not very many examples of these investment banks losing money in this capacity. Sometimes they'll get other people involved and have a group of syndicates, selling group doing this with them. All right, investment banking. When they are selling Bill's company for $40, $60 million, they will go on a road show. They will be in what's called a quiet period while they're on this road show, which means they will register Bill's company with the SEC, and 20 days after that, they can take the company public. 40 days after that, they can start talking public. They can start saying things that are not private, that are not on the prospectus. So in that 60-day period, they can only say what is in the published material on Bill's company. We talked about how very high net worth people, very influential customers of the bank are in the room in this roadshow. Supposedly, however, they cannot tell them anything that they are not saying publicly in the prospectus.
Because that would be insider trading of some sort. Or insider information.
Sounds right, yeah. And they will build their book. They will ask people to sign up. They'll say, Patrick, how many of Bill's shares do you want? They hope they are oversubscribed. They hope they get more interest than they can actually sell at this company. And because they want to be oversubscribed, they will typically underprice. They'll underprice this great company that Bill put his sweat and tears into for the last 20 years because they want to have more demand than they have supply. Because you all are preferred customers, you all in this roadshow, preferred customers maybe because you generate millions of dollars for the bank in other areas. And they want an honest interest of whether or not they can sell this stock. Because of this underpricing, there tends to be a run-up on price in the first day of trading. So we sell Bill's company for $60 a share. At the end of first day of trading, the shares are selling for $78. And then Bill's like, ooh, why didn't I get some of that money? Well, he's a little disappointed, but he's happy because he's a millionaire. He also accepts this what we call money left on the table, the difference between the end of the first day trading and the price that the bank paid Bill initially, because he likes the excitement that was generated for his company. He might be holding on to extra stock himself, and he's like, yeah, I'm glad this stock I left in my pocket is increasing in value along with all the other people, rich people who are sitting in the room in the roadshow. And he might want to take future offerings. He might want to go back to the market and say, I want to sell more stock. So if this goes well, then that's going to help him in the future. That's why he tolerates this money left on the table. And then we just enjoyed this example of the fees, the spread, and that kind of thing. I don't think you won't be tested on this. There was nothing on this on the quiz, right? Yeah. So, but it was fun. It was fun though. We looked at this Malibu Boats example where the costs, they got receipts of $98 million, but the company value at the end of first day of trading was $130 million. So they gave Goldman Sachs and the other investment banks $30 million, $31 million just for 5 or 6 months of work of knowing people. Right.
Not bad.
Yeah. All right, the SEC does certain things. They regulate initial public offerings. Remember, you have to register with the SEC 20 days before you go public, and you have to create this perspective by SEC regulations. SEC will also monitor reporting, monitor inside trading, arrest you if you manipulate the market, and monitor the process for proxy statements. If you're going to send a proxy statement to your shareholders, it has to be done a certain way with certain regulations. Okay, we talked about equity carve-outs. So these are slightly different than IPOs. Instead of the whole company going public, the equity carve-out would be a small section of the company, say a line of, let's say you make tennis rackets, and the division that makes tennis balls is going to go, you're going to carve that out. You're going to say, I want that part of the company to essentially go public. This has many of the advantages of going public. You can evaluate that line of business. You can give those managers incentives. There are also disadvantages, very similar to going public. There are underwriting costs. The pricing could be not favorable to you. Your management now has to deal with investors. You have these minority interest owners who are always hassling you, saying, make the tennis balls a little bit different. And you have to report to the SEC. Same kind of advantages, disadvantages of going public. All right. Other means. We talked about other means of raising capital. Shelf registration. This was for very large companies. They didn't need to go through the 20-day waiting period. They can register and essentially hold that registration on the shelf. Now, if they're a company that is very actively traded, very big company, the SEC says, well, everyone knows about your company. There's enough public information that people who invest in it are not going to get cheated because they can access what's going on, they can see what's going on. So they're able to do a shelf registration and issue more stock faster. I think your textbook used the example, they can plant it in the morning and sell it in the afternoon. Private placements. Instead of offering shares to the public, you can offer shares to accredited investors, such as institutional clients, pension funds, hedge funds, very high net worth individuals who meet certain specifications. And the SEC says, oh, you can sell to those people without going through the whole IPO process because they're, quote unquote, smart investors. And securitization, another way of raising capital. The most common form of securitization, mortgage-backed securities. If you're a bank, you loan a bunch of money for people's houses, and you want to get rid of that debt and get more capital into your bank. You sell a security backed up by the value of the house. All of a sudden you have that loan off your books. You have more money in your company to do more stuff with. Makes sense? All right, investment bankers. They do M&As, matchmaking, advising, underwriting. They do that asset-backed securitization type of thing. Asset management, they manage people's investments. They do trading as well. And we talked about a leveraged buyout, which is or going private, which is the opposite of going public. So if you're a public company and you are a private individual looking at this company saying, oh, this public company, the management is not very efficient. They're spending too much time dealing with the SEC and investor relations. I and my really rich friends or this bank that's going to loan me a lot of money, we want to buy this company, take it private, increase the value, and then sell it again a few years later. That's what we mean by going private. Some advantages. You don't have costs dealing with the SEC. You can get the management on board with you, the CFO, the CEO, COO. Yes, flexibility. Use financial leverage to increase your return. Okay. Got any questions? Am I going too fast? All right. Right. Mergers and corporate control. All right, M&A. Let's see, types of merger. Horizontal merger. Oh, one firm combines with another in the same line of business. Vertical merger. You just need to know that term. That's a firm in your supply line, your supply chain. Congeneric merger. Two firms in the same related industries, but the related industries, but not producers of the same product. Lastly, conglomerate merger, unrelated firms combined. The reason why mergers tend to increase value, synergy. 2 plus 2 equals 6. When you combine these firms, they'll be able to leverage customer relationships. One accounting department, one HR firm. They will be able to make more money combined than they each did if you added them up separately. There are some questionable reasons for mergers. Sometimes managers have personal incentives. They want to become a bigger company for their own personal reasons. Sometimes they are just trying to acquire a firm to make it more difficult for them to be acquired and lose their jobs. Actually, one other questionable merger is diversification, or questionable tactic for, questionable reason for a merger is diversification. The term a conglomerate merger is when two unrelated firms combine. Now, the management might say, well, we want diversification. In case things are slow in the tennis market, we want to be able to sell TV radios, something like that. Now, the argument against that is why would you, as an owner, as an investor in a firm, need a firm to diversify for you when you can easily buy stock in one tennis racket company and another TV radio company? You just want firms to do what they do best. It doesn't necessarily help the investor. It will often help the managers weather storms, however. All right, let's see. Friendly merger, hostile merger. Okay, so if we are going to merge with a firm, we need to calculate the value of that firm. We could do it by calculating the value, ways we've figured in the past with our value calculations, but we learned a different way in this class called the compressed adjusted present value. The thing with this is that throughout the merger process, the capital structure may be changing rapidly. So what we want to do with this case is measure the value of a firm if it had no debt, add the value of the tax savings if we did have debt, and that will give us the value of operations. Let me fast forward here to our example. Think about working this out. All right, so we've got a firm. We've got cash flows next year, the year after, the year after, the year after, the year after. This top line, this is the information we have. We're considering buying this firm. We want to know how much it's worth. So we're going to discount all these cash flows back to present value, and you will be given the discount rate of an unlevered firm. Now, in year 1, 2, 3, 4, 5, in year 5, we're going to assume that this company is going to stabilize, its capital structure is going to stabilize. And we know it's going to grow at a constant rate. So standing in year 5, we look and we say, how much is getting that cash flow forever at a rate that grows worth to us? And so we use a growing perpetuity to calculate that. So we look at this cash flow in year 5, standing in year 5, 2021. We say, how much is the expected growth rate? Well, that's what it's going to be worth the next year. We know also it's going to grow at a rate of 6% forever. So we use this value of a growing perpetuity. Does everyone recognize that? This is the value of a growing perpetuity. All right, and it's important to remember that standing in, so year 1, 2, 3, 4, 5, standing in year 5, we look at this 2194. How much is it going to be next year? Divide it by the cost of capital minus the growth rate, and that's what it's worth still standing in year 5, 418.3 million. And we're going to have to discount that back to present value along with everything else. And we're going to do the exact same things with the tax shields. We're going to have information that are going to say the tax shields in year 1, 2, 3, 4, 5 are worth this much. And then standing in year 5, going on forever, the taxes are going to grow at this such and such rate. And we're going to use the present value of a perpetuity in year 5. But that itself is going to be 5 years in the future. And we're going to discount everything back to present value. I'll take a breath there. Because that's fairly straightforward, but I know it can be a little confusing.
Just a little.
And there is, I believe, one question on this. Any questions on that? So we just want the cash flows, we want the tax shields, and then this one little nuance in the end of the time horizon, we say what's that worth using the growing perpetuity formula forever, and then these are the 1, 2, 3, 4, 5 numbers we're going to have on our Excel sheet, and then we're going to use Excel the way we calculated in Excel 45 minutes ago with the discount rate which will be given. It's going to tell us how much that's worth. Do the tax shields, do the unlevered cost of the firm, add it all together, and you'll say, all right, the value of this firm, 344 million. Right, that's the value of those assets. This company is generating $344 million worth of assets. Now there are 2 sets of owners to this firm. There's the stockholders, and there are debt holders. The debt holders may have a small piece of that. So if we want to calculate how much we pay for the stock, we subtract off what the debt owners own. So say there's 55 million of debt. All right, that means the stock itself is worth 289 million. We divide that by the number of shares, and we'll get a share price. And in this example, we divided by the number of shares, and we got a share price of $14.47 per share. And we crunched the numbers. We said if we buy this firm, it's going to be worth $14.47 a share. And guess what? The current share price is $11.
That's good.
So let's offer them $11.50. Unfortunately, apparently it doesn't work out quite like that. Once investors smell the merger, they're like, ooh, we're gonna clean up on this. The investors say, we want all the synergy value. All right. Okay, we assumed a higher tax rate or more debt, and we said, wow, look at how much more money we can make if we use more debt. But it was just the same calculation. Oh, okay. One other thing that was fun for us to talk about. Sometimes a company will engage in defensive merger tactics. They will change their bylaws. I gave that silly example. They might create a rule where you can only elect 1 board of directors every year, and there are 10 board of directors. So even though you take over the company, you're going to be stuck with these folks for 10 years. You could appeal to the stockholders, say you shouldn't take this deal. They're only offering $11.25, and they're going to come in, they're going to break up the company, and that's not what you want. Maybe it is, maybe it's not. Antitrust issues, they could go to the federal government and say, now we care about antitrust issues, especially if this merger goes through. Purchase to increase price. Oh, purchase, yeah, we talked about a firm that's being acquired could buy another firm in the process to increase their price or make it more difficult for them to be acquired. Find a white knight, someone to come in and buy the shares, someone who you like, who's not going to break up the company, or it's not going to fire all the managers. Or you could find a white squire, which is someone who has enough money, not necessarily to buy the whole company, but enough money to just block the merger, buy enough shares that another person cannot take them over. Alright, divestitures. Alright, so when we talked about IPOs, we said there's a little different version of an IPO, which is an equity carve-out, which is where you just take a piece of the company public. Mergers, it's the same type of thing. You can merge with a little piece of the company. If you're a company, you can sell off a little line of business, sell off a subsidiary. You can spin off a subsidiary by giving stock to the existing shareholders. Say we used to be one company, now this department that makes tennis balls is a whole separate company, and here's your stock, your ownership in that company. Carve out subsidiary. I don't think we talked too much about this. Outright liquidation of assets. Alright, just sell everything, I guess. Holding companies. Alright, we talked about this idea of holding companies and a couple different advantages. So you have a holding company. Alright. And you have 3 companies. A, B, C. You can separate the risk between company A and company B. They have nothing to do with each other. They are owned by the same person. Hopefully no one will notice.
The only bad thing with that I think is that it was the taxes. I think the people who own the holding company get hit for taxes for the holding company and then get hit because there's the common ownership for A, B, and C.
Exactly. First, Dave pays his taxes, and then the profits go to the holding company, and then they pay their taxes.
Then I guess just for legality reasons, if somebody sues company A, could they technically also sue company B and C and the holding company because the holding company has, ownership in that?
I guess so, but the advantage is there's some protection against that. So you're better off with this structure than you are having A and B combined. So it depends on how good your lawyers are when they drew up this contract, or how good your lawyers are when they...
Or you just hope that the state that you're in doesn't have some kind of a loophole.
Sure.
We had that with New York with leased vehicles. It was called vicarious liability law.
Oh, yeah?
So if I'm driving a leased vehicle through Honda and I rear-end you,
Okay.
you can sue me, the driver of the vehicle, and then you could sue Honda
Okay.
as the owner of the vehicle.
Before you go, let me tell you, I worked out the trade credits, the 110 net 30 type thing, and the formula works. The formula for the nominal rate of return works. Where I got confused was sometimes you can delay payment. Like if you're net 30, you don't necessarily have to pay on day 30. If you're able to stretch it out longer, sometimes apparently there's no penalty for that. But so the longer you can stretch it out, the lower interest rate technically that you're paying. So that's why I got confused. Because it's like, it's net 30. I'm like, well, you have to pay after 30 days, right?
Yeah.
But the textbook example gave us an example where you didn't pay until 40 days. And that just, the longer you take, the lower the interest rate becomes. So we'll still use the same formula.
So it benefits you to take longer?
Yes. Yeah, it's like, what's the supplier going to do? Say we're not going to sell to you anymore?
Yeah.
Say pay this fine?
I guess if they want to make the deal, they're like, okay, no, you can have a longer interest rate.
Yeah, I guess that's what's implicit in the question is that you can take longer to pay. All right, but great having you in class. So see you another time. All right. Okay, great. Moving right along. How's everyone? Gonna take a break? Good. Yeah. All right, you're good. 6. All right. Okay. What do we got here? Dividends and repurchases. Okay, so sometimes you're wanting to get money back to your investors in the form of a dividend, or you're going to want to repurchase stock. Okay, let's talk about theories of investor preferences for dividends. First is dividend irrelevance, which says investors don't care. Right? If you give them dividends and they want the cash, they're like, great. If they don't want the cash, they'll just use that to repurchase shares. So why would they care? Well, the reason they would care, tax implications, brokerage costs. They would have to pay taxes when you give them the dividend, and they would have to pay a broker to reinvest in the firm. So they do care. There's another theory, dividend preference, which says that investors prefer the money now. We saw the empirical evidence, which states that in some developing countries, investors like dividends because they have less protection if something goes wrong and they lose out on money. We looked at a tax effect dividend payout theory, which says that investors like a lower payout so they don't have to pay taxes. We use that example. If you're investing for the long haul, 20 years, and you have to pay taxes in the middle of that at year 10, that lowers your asset base. And if you don't have to pay taxes, you're able to accumulate more money, essentially money that Uncle Sam will get one day, but in that interim, you get to earn interest on that money. Alright. Clientele effect. Alright. This states that clients, investors in a firm, like a certain dividend payout. If they want dividends consistently coming to them, then they will invest in a firm that consistently pays a dividend. If they don't want dividends, they will invest in a firm that never pays dividends. And if you do something that upsets your clientele, sometimes they'll be mad. So, firms like to stay consistent with their policy. We used a model to calculate the amount of dividend you might pay, called the residual distribution model. This was the distribution, the amount of the dividend, is calculated by taking your net income minus the amount of equity you need for capital projects. We further broke that down by saying, well, what is your capital budget for the next year? How much of that is going to be funded with equity investments? And we're going to take the difference between our net income for the next year and that amount, whatever is left over, we're going to pay out as a dividend. And I think there is one question on the exam about residual income. And you can look at this example, take a look at your equity ratio, your capital budget, your net income. All right, how much of that capital budget is going to be funded with equity funds? Well, it depends on your equity ratio. All right, you calculate that, and whatever's left over, you'll pay out in dividends. Makes sense? All right, signaling hypothesis. Another nuance on signaling hypothesis. We talked about the fact that when a firm declares a dividend and says, we're going to start paying dividends, the market says, wow, that's good news. This firm must have a lot of money. They also like it when a firm consistently pays dividends. The opposite is also true. When a firm says, we're not going to pay a dividend this year, sometimes that can send a negative signal. The market can say, well, why is Apple not paying a dividend this year? Maybe they're not making money. Maybe they're in financial trouble. I'm going to sell the stock. The price might go down. For that reason, managers like to be consistent. They do not declare a dividend unless they think they can sustain it, and they hate to cut dividends. So, given that signaling hypothesis, you might use the residual dividend policy to set a guideline for how much dividend you will give out, but you don't need to be a slave to it. It's better to be consistent. Let's see. We went through an example. So let me actually skip ahead here to the bottom line of stock repurchases versus dividends. We found For a stock repurchase, the stock price does not fall at the time of the purchase, but the number of shares falls. So for a stock repurchase, it's like you're taking a little piece of the pie away. It does not affect the size of anyone else's pie. For a dividend distribution, you are, the stock price falls by the amount of the dividend. You had money in the firm, and then you gave it to the owners. So of course the price of the firm, the value of the firm is going to go down by that amount. Number of shares, however, does not change. I think that's just the intuition that you might want to be familiar with. Don't think there's a dividend or repurchase example. I don't think we need to go over that. Stock dividends and stock splits. So if I'm going to split my stock, if you have 20 shares, I'm going to split stocks, and I'm going to say now you have 40 shares. This actually doesn't change the value of your investment, but is often a positive signal, meaning I think the value of this company is going to go up, and I don't want your share price to get too unmanageable. Stock dividend is the same, is similar. Instead of an outright split where I give you 2 to 1, I may give you, 1 stock for every 10 that you have. Something like that. Also, in theory, stock dividends do not change the value, do not change your wealth, but they're a positive signal. Okay. Dividend reinvestment plan. This is the situation where if you don't want to deal with dividends from your company can automatically reinvest those dividends into more stock. Now this saves you the hassle of dealing with a bunch of checks for 20 cents at tax time and keeps you invested in the company. Disadvantage though is every time they do that, you need to pay taxes. And you'll get you won't probably mention in class, I mentioned I didn't even know I had gotten dividends until I saw a note from my accountant saying I had to pay a slightly higher tax rate for these non-qualified dividends. So there is that disadvantage, but dividend reinvestment plan can save you the hassle and get you reinvested in the company. Any questions? All right. I think that's it. Fantastic. Okay, class 7.
That's the class I missed.
2.
Good night.
Okay, good night.
Thank you.
Thank you. All right, we got leasing. All right. So what do we talk about? Leasing, types of lease. We talked about an operating lease versus a capital lease. And an operating lease is, for lack of a better term, a real lease. A capital lease is a lease in name only and a disguised loan. So if the lease is a capital lease, also kind of called a financial lease, then you must capitalize that lease. You must put it on your balance sheet. If we have a lease that is long-term, non-cancelable, you're responsible for maintenance, that is like debt. It's like you owe money. It's like you have that liability, and you are required by the SEC to capitalize that if it fits certain criteria. In addition to that, if a lease is actually a loan in disguise, the IRS says that is not a guideline lease, that is not a tax-oriented lease, so you're not going to be able to deduct the full lease payment for tax purposes. You're only going to be able to deduct what would have been the loan payment for tax purposes. So we talked about leasing as a substitute for debt. We also talked about some advantages to leasing. Like how did we do it? We assumed Ryan was leasing from Mallory, and we said that this situation can work out well if Ryan does not have profits. He cannot take advantage of the depreciation from owning the asset, but Mallory can because her company has profits. So it works out better if if Ryan leased from Mallory. We also talked about the idea of what if Mallory has a higher tax bracket than Ryan, right? She can take more advantage of the depreciation of owning the asset, and then she can give Ryan a lower cost to lease the asset. All right, back on capital structure. For accounting purposes, okay. So if we have a capital lease, we must put it on our balance sheet, capitalize it. All right. We talked about these criteria that the Financial Accounting Standards Board, under which they would require a company to put a lease on their balance sheet. So in my company, if I'm leasing certain assets, if they fit any of these criteria, then I have to put it on my balance sheet and say I own that asset. And we don't really need to think too much about these other than these are indicators that this is a loan in disguise. So if it is a loan in disguise, we need to capitalize it with the present value of all lease payments on our balance sheet. And then the same thing with the IRS. If this is a loan in disguise, then we are not allowed to fully deduct the cost, the lease expense, if we are paying for the leaseor. We are only allowed to deduct what would be the interest payments if we owned the asset. But even if a lease doesn't fit the criteria according to the IRS of a guideline of tax-oriented lease, there's potentially an advantage. It can help us decrease our alternative minimum tax. Okay, I believe there is a lease versus buy example on the exam. So let's take a look at this example. So first, let's look at the value of owning an asset. Let's see what's the present value of that. And then let's look at the example, what if we lease the asset? What is the present value of that? So if we own it, we're going to have a loan payment, and we're going to get a tax advantage on that loan payment. This loan payment could be after tax or could be before tax. In this particular example, it's after tax. So we already have the tax advantage taken out. I think the loan payment was like $100, and we're in a tax rate of 40%. So our after-tax loan payment, it's like we're only paying $60. Does everyone understand that? All right, so we're paying $100, but we're only going to, it's only a negative 60 because we get a tax advantage. There's depreciation for this asset, right, and 40% of that depreciation can be used as a tax shield. There's maintenance we need to pay for owning this asset. There's a tax saving because of the maintenance. There's a residual value at the end of this ownership period when we're going to sell it to someone else, and that's positive money for us, but we're going to need to pay taxes on the residual value. So we add all these up. In year zero, the maintenance combined with the tax savings. Right, this is $20,000 that we need to pay, $8,000 tax savings that we get gives us $12,000. In year one, we have to pay this negative 60. This depreciation is not something we add in directly. This is just how we calculate our depreciation shield. So it's negative 60 plus 133 minus the 20 for the maintenance that we get to pay, plus 8 because that's a real tax advantage, and that's going to give us 61. We'll do the same thing for year 2, 3, and 4, and this is going to give us our net cash flows in year 0, 1, 2, 3, and 4. We're going to have the discount rate, which is going to be the cost of debt, because leasing and loans are similar in risk. And we're going to use our fancy net present value that we know how to do in Excel to calculate the net present value of these investments. And we're going to get a net present value of negative $590,793. All right, so that's our present value if we own it. And now we're going to calculate our present value if we lease it. A little more straightforward. We're going to be given the lease payments, $260,000 each year for 4 years. due immediately. Because this is a guideline, tax-oriented lease, we are able to deduct the full lease payment. We're going to get $104,000 in tax savings because our tax rate is 40%. And this is going to give us our net cash flows of $156 in year 0, 1, 2, and 3. We're going to discount that at a rate of 6%. We're going to get a present value of negative $572,000. So that is better than negative $591,000. So we prefer leasing. And I believe there was a question on your quiz about this, so just refresh that, make sure you're good to go with that, and you can plug the numbers in for that question on the exam. And the one other thing we want to think about is the leasor's analysis, the person who buys the asset and is leasing it to someone else. Remember we talked about the lease versus buy example as a financing decision? All right, so I need these airplanes. How am I going to finance the airplanes? Am I going to buy them and pay the bank the loan? Or am I going to lease them from someone else and get some advantages that way? Because the person who's leasing it to me, they may be able to take advantage of the depreciation more than I can. From the standpoint of the leasor, the person who is buying the asset and leasing it to someone else, is an investment decision. It's how much return can I make on this investment compared to investing somewhere else. Maybe if I get in the leasing business, I can make an 8% return. If I get in hedge funds, I can make a 9% return. If I get into whatever junk bonds, I can make this amount of return. So from the lessor's perspective, we want to find present value. How much money are you making on this investment? And we went through one example. We said, suppose you're going to buy something which costs $10,000, and you'll be given all this information. You just need to know how to plug it into the Excel chart. You're going to pay $500 a year in maintenance. If this were the way you would set it up, the question would say maintenance payments begin immediately. You're going to get a tax saving because maintenance is a deductible cost. You will be given information about how much you can depreciate this asset. You're going to multiply that by your tax rate, and that's going to tell you how much your tax shield is worth. Someone's going to be paying you a lease payment. You'll be told what it is, and you plug it into your chart on Excel. You're going to have to pay tax. That's income. You're going to have to pay tax on that. And there may be a residual value where you can sell this in the last year, but you are going to have to pay taxes when you make that sale. That's going to give you net cash flows at the end of the year. You're going to put all that back to present value, and you're going to say, I've got an NPV at the discounted rate that was appropriate for this problem. If I have a positive NPV, yes, do it. Buy the thing and lease to CMR. Okay, any questions? All right, ready for the last class? All right. So this last class, I was excited about teaching it last week, but I feel like I saw a number of blank faces. So I hope I taught it effectively, because I think it's interesting in that we can peel apart those nuances of free cash flow and working capital. I feel like we've gotten to a point where we can appreciate it, but I also see that it's tedious. So I'll try to go through the highlights of it now and make it as exciting as possible. All right, supply chains and working capital management. All right, we talked about this idea of free cash flow being a key factor in value. And we calculate free cash flow based on our net operating profit after taxes, but also we need to subtract off required investments in operating capital. Now that could be a couple things. One, we could buy a building. All right, that's not going to affect our revenue, but it is going to affect our free cash flow. It's going to decrease our free cash flow. If we have to buy a building every year for $1 million, that's less free cash flow that our investors, our owners are going to get. Now, the nuance here is we said also if we have to increase our working capital, that is going to decrease the amount of free cash flow that our investors get. And we can increase our working capital with a couple of ways that are dangerous or particularly problematic. One is inventory. If we increase our inventory drastically, that is going to decrease our working capital. If we increase our accounts receivable drastically, that is going to decrease our free cash flow. Or, if we decide we want to pay off our accounts payable faster than we need to, that is going to decrease our working capital. Or decrease our free cash flow. Decrease our working capital, which decreases free cash flow. All right. I'm going to come back to this, but since I'm on a roll with decreasing our working capital, specifically, we had a metric to evaluate how effectively we're managing that working capital. And we called this our cash conversion cycle, which is our inventory conversion period plus our average collectible period minus our deferrables payable period. So, how long does it take us when we buy a piece of inventory to get that sold? How long does it take us once we sell that inventory to collect? And then how long can we hold off the creditors before we need to pay them when we initially bought that inventory? The longer the better. The shorter the better for inventory conversion, shorter the better for average collectible conversion, longer the better for payables deferrable period. Because we want this cash conversion cycle to be as short as possible. And you'll have to calculate cash conversion cycle. I will give you information on that, and you'll calculate the different components of it. And they are inventory conversion period, inventory, divided by cost of goods sold per day. You'll be given COGS. You may have to divide by 365 to get cost per day. Average collectible period. Receivables divided by sales per day. Payables, deferral period. How much is our payables? What is our cost of goods sold per day? We put that all together in an example, and we can calculate our cash conversion cycle. Okay, we want to decrease that because we'll decrease our interest we're paying because we are without cash for less time, and it will lower our working capital, which will increase our free cash flow. Okay, nuts and bolts of actually doing that. All right, calling up our customers and hassling them, saying, pay now. All right, trade credit. This is what I was telling Alexandra and Mallory as they were walking out the door. We went over this issue of if you are buying money from suppliers, they may offer you trade credit. You don't have to pay right then and there. They may say, I'm going to sell you this on these terms, 110 net 30, which means if you pay within 10 days, I will give you a 1% discount. If you don't pay within 10 days, I expect the entire amount in 30 days. So the question is, do you want to take that discount? Well, let's calculate what that is worth. What is the interest rate you are paying by foregoing, by taking the extra 30 days. So that extra 20 days, what interest rate are you paying? And what I was saying to Alexander and Mallory before we walked out the door, sometimes you can take even longer than the 30 days. Your textbook gives you many examples. If you can take 60 days, you can take 70 days, and what's the supplier going to do? They'll call you and harass you. But as long as they keep selling to you, then you're getting a lower nominal interest rate.
Sometimes they charge a penalty, though.
If they charge a penalty, then you're going to have to work that into your calculation. But the question on your quiz, which you took for today, and the question which you will take on the exam, there's no penalty
Yeah.
for paying late. Right? The question doesn't say anything about a penalty. And incidentally, if anyone got that wrong on the quiz today, I will change that because there was some. You got it right? Good. Because there was some confusion, I explained it in a slightly awkward way. I misexplained the way this works, but the reason I misexplained it is because sometimes you can take longer than the net 30. All right, so calculate the nominal rate, discount percentage divided by 1 minus the discount rate, times 365 divided by the days taken minus the discount period. So, Discount percentage is 1% because you're going to get 1% if you pay within 10 days. 1 minus 1 is 99. 365 divided by the days taken. So if I'm paying on day 40, all right, minus the discount period, which is 10 days. So I'm taking an extra 30 days beyond what I would get the discount. So I'm holding that money for 30 days longer. What is the amount of interest I am paying in that 30-day period? Crunch the numbers and you'll get an answer. And like I mentioned to Alexandra and Mallory before they walked out the door, the longer this period is, the better for you. All right, the better you're able to manage your money supply. Your creditors may not like it, but you'll still calculate your nominal interest rate this way. Does that make sense? Okay, I'm going to go back. I think that's it there, and I'm going to go back and explain one thing with supporting these current assets. Free code, yeah, that's it. Okay, so we've just got this one thing left. This is the question of how do we finance our assets? So we're a company, we have fixed assets, we have permanent assets, and depending on the cycle, the business cycle, we may need a little bit more inventory, we may need a little bit more in our accounts receivable, so we're going to have what we call temporary current assets. Question, how do we finance those assets? 3 methods. The maturity matching method, the conservative method, and the aggressive method. For the maturity matching, says we want to manage our permanent assets with long-term stocks and bonds. And we want to finance our temporary assets with short-term loans. If we need some inventory for the next 30 days because we need stuff for the holiday season, then we'll get a short-term loan. Everything else that we're going to have forever, we'll finance with long-term assets. If we want to be more conservative, we might say, hey, we know we're going to need these temporary assets every holiday season, so we might as well secure long-term financing ahead of time. Finance everything with long-term assets if we want to take a conservative approach. If we want to take an aggressive approach, we might finance all of our temporary current assets with short-term loans and some of our permanent assets with short-term loans. Now we're taking a risk because we know we're definitely going to need to finance these permanent assets, and we're hoping that interest rates aren't going to increase or credit's not going to dry up. Questions? All right, so I'm going to do what I'm going to do at this point, and I'm going to take a minute, 5 minutes or so, 10 minutes, just sort of break, refresh, but I will be here and I can go through the quizzes one by one, or we can go on specific quiz questions that you have. If you feel like you've gotten enough out of the review already, then you're welcome to leave. And the exam will be available later tonight when I get home. I'll make it available to you. Please complete it by next Thursday at midnight. All right, so if you decide to stay, I'll be back at 8:15, and we can go over whatever quiz questions you like. But if you're leaving, then I guess say goodbye. Is anyone leaving already?
Yes! I'm going to see you again.
All right, great having you in class. Fantastic. All right, you leaving? Staying? Oh, great having you in class. You leaving, Sasha?
Nice to meet you.
Oh, nice to meet you,
actually.
Mwah.
You're leaving? All right, that's fine. You don't need to stay for my benefit. But great having you on in class. If you change your mind, I'll be here. But if not, good luck on the exam.
Thank you.
Thank you.
Thank you.
I plan on.
I
I'm planning on
always,
doing it
always
over
my
the weekend.
phone. I forget.
Is it like, are you guys doing together as a group? It's just in
Well, you basically do taking what you did in your group, what you done, but just put it in your own words.
so it's
Perdón.
that we not keep I thought because what he said to us we can still have to do it in English.
Let me go to the bathroom. Load everything.
So it's like what do you like I did a few mistakes in the income statements.
we actually made a mistake on the interest expense part of the income statement. So we said that he would still give us A's on our individual papers if we changed that.
How much do you give for that? Do you for the interest? The percentage.
You know what? He threw in a thing about the whack that's part of the figuring out the interest expense, which he didn't tell us about. So
Really?
I don't know how to explain it, but
And it's weird. It was kind of hard to get the data, and I don't understand a lot of things.
see it.
Bye.
So how are you doing?
Good.
Are you in Giuliani's class?
Yes.
You got the airplane project?
We just did our presentation.
We did it at drugstores when I was in this class.
Good luck on his exam.
I'm sorry?
Good luck on his exam.
Oh, actually, I'm not taking the exam.
All right, one student left in class.
Yeah.
Let's see. For those of you watching this at home, it looks like everyone is gone home. If you have any questions, let me know. Great having you in class.